Merton Model for Credit Risk Management and a Case Study. Robert Merton published a seminal paper that laid the foundation for the development of structural credit risk models. In this post, we're going to provide an example of how it can be used for managing credit risks. Within the Merton model, the equity of a firm is considered a call option on its asset, and it is expressed through an equation, where E denotes the equity of the firm. V is the firm's asset. Sigma V is the asset volatility. B is the notional amount of the debt. R is the risk-free interest rate. We note that both asset and its volatility are not observable. However, the asset volatility can be related to equity and its volatility through an equation, where sigma E denotes the volatility of equity. These two equations can be solved simultaneously in order to obtain V and sigma V, which are then used to determine the credit spread. Having the credit spread, we will be able to calculate the probability of default, PD. Loss given default, LGD, can also be derived under Merton framework. A graph on our website shows the term structures of credit spread under various scenarios for leverage ratio, VV. It's worth mentioning that the Merton model usually underestimates credit spreads. This is due to several factors such as the volatility risk premium, firms' idiosyncratic risks, and the assumptions embedded in the Merton model. This phenomenon is called the credit spread puzzle. Research is being conducted actively in order to improve the model. We are now going to present a case study based on the Merton credit risk model. Our client is a junior gold miner. They are looking to raise additional capital in order to finance the production of gold. The client currently has an outstanding liability in the form of future discount for the payment of deliverable gold. According to a contingency clause, the buyer can exercise a certain amount of cash into a secured obligation. This conversion will increase the leverage of the company, thus leading to higher credit risks. We determined the increase in the credit risks by using the Merton structural credit model. We estimated that if the buyer exercises the cash conversion clause, the credit spread of the client will increase by approximately 20%. We thus helped the client better negotiate the deal with their counterparty.